Over the past few weeks, luxury retailer Saks Global filed for Chapter 11, weighed down by around $2 billion in liabilities and more than 8 million square feet of luxury space suddenly up for grabs. That headline isn't just another corporate failure, it's a warning bell for small Atlanta landlords whose fortunes are often tied to one anchor tenant. Yet Atlanta is even tighter. Vacancy sits around 4.3% and rents climbed roughly 3.5% year over year. Investors poured more than $360 million into local retail properties last quarter, despite net absorption turning negative. With limited new inventory and investors still hungry for well-located assets, small landlords hold a powerful hand if they play it smart. The backdrop for 2026 is a tale of scarcity and fragility. On the scarcity side, less than 0.2% of Atlanta's retail inventory is under construction. Nationally, new retail supply is near multi-decade lows. Projects that do break ground are almost always pre-leased or built to suit for national chains like Chick-fil-A, Starbucks, and Circle K. That leaves very little speculative supply. On the fragility side, anchor stores are failing. Department stores and large fashion chains are contracting under the weight of e-commerce and shifting consumer preferences. Meanwhile, smaller formats, boutique grocers, fitness studios, nail salons, and medical clinics are thriving. The typical new lease signed in 2025 is under 3,500 square feet. To understand why this matters, let's start with the macro picture. The US consumer has been remarkably resilient. Consumers are still spending, but they are trade-down shopping and demanding value. Monetary policy sets the tone for real estate investing. The Federal Reserve cut its benchmark rate 3 times in 2025, ending the year between 3.5 and 3.75%. These cuts lowered borrowing costs and stabilized cap rates across retail segments. However, lenders remain cautious. They demand higher equity contributions and strong tenant rosters before financing acquisitions or construction. Lenders remain conservative and favor essential or needs-based tenants. Expect tighter terms and more equity. Next, let's zero in on Atlanta's retail landscape. The market remains one of the tightest in the country. Availability sits near 4%, and overall vacancy is roughly 4.3%. While that figure is up slightly from the prior year, it is still far below national norms. What stands out is the disconnect between negative net absorption and rising rents. In 2025, net absorption was approximately minus 1.7 million square feet, driven largely by national retailer bankruptcies and corporate downsizings. Yet asking rents climbed around 3.6% to about $23.63 per square foot. This tells us something important. While some vacated space lingers, the majority of available space is being repriced upward. Scarce new construction amplifies this effect. Only about 0.2% of Atlanta's retail inventory is currently under construction, and most of that new supply is already pre-leased or built to suit for national brands. The few speculative projects that do exist are small in scale and often focused on local concepts such as Upper West Market and Terminal South. Leasing velocity remains strong for smaller format spaces. Market time for new leases has dropped below 6 months. In-demand concepts include quick service restaurants like Chipotle, coffee chains such as Starbucks, boutique fitness studios, nail salons like Sugar Polish Nails, medical clinics, and value-oriented grocers. Meanwhile, larger format vacancies have increased, not because demand has disappeared, but because big box spaces are harder to backfill and often require subdivision. Northern suburbs like Alpharetta, Roswell, and Marietta capture an outsized share of leasing activity. That demand is driven by strong household incomes, continued population growth, and highly rated school districts. Retail follows rooftops, and these suburbs continue to attract both. In-town districts such as Midtown and West Midtown are also gaining momentum. Rising residential density, new multifamily deliveries, and the emergence of life science and tech clusters are reshaping tenant demand. As office, residential, and mixed-use projects expand, retail increasingly becomes an amenity, not just a destination. Each submarket behaves differently. Tenant size preferences, rent tolerance, parking needs, and operating hours vary widely across the metro. That means landlords cannot apply a one-size-fits-all strategy. Submarket-specific positioning is now a requirement, not a luxury. Investment activity underscores confidence in Atlanta's fundamentals. The Metro recorded $364 million in retail sales volume in the last quarter of 2025, outpacing many peer markets. Pricing averaged around $225 per square foot, while cap rates hovered near 7.2%. Despite higher interest rates and some moderation in rent growth, investors continue to allocate capital to Atlanta retail. Why? Low vacancy, consistent population inflows, and a structural lack of new supply. Capital is prioritizing assets with strong locations, durable tenant demand, and redevelopment upside. Recent transactions highlight that trend clearly. Shaked Acquisitions completed a $64 million purchase of Cobby Place Center, betting on long-term fundamentals in a supply-constrained corridor. Georgetown Company acquired the Kroger-anchored Kedron Village for approximately $63 million, underscoring investor appetite for grocery-anchored retail. Another notable deal was the $29 million sale of Mall West End, paired with plans for a $450 million mixed-use transformation. That project illustrates a broader theme playing out nationwide. Retail assets are increasingly valued not just for current income, but for their ability to support densification, repositioning, and long-term optionality. These transactions send a clear signal. Capital has not abandoned retail. It has become more selective, more analytical, and more focused on assets that can evolve. And that brings us to the core strategic question every landlord must now confront. How do you position your center to remain competitive as tenant formats shrink, anchors weaken, and flexibility becomes the defining advantage?
Now let's dive deeper into the 4 forces driving your strategic decisions. Force 1, anchor fragility. The days when a single department store could anchor a shopping center for decades are over. The bankruptcy of Saks Global highlights the vulnerability of high-end fashion anchors. But this issue is not limited to luxury retail. Even mid-tier department stores are closing locations, downsizing footprints, or renegotiating leases. At the same time, other categories are moving in the opposite direction. Pharmacies, discount grocers, auto parts stores, and other essential retailers are expanding. If your center relies heavily on an apparel-driven anchor, you should begin contingency planning immediately. Start by assessing your anchor space itself. What is the total square footage? Can the space be subdivided into multiple smaller units? Are there mezzanine levels or excess ceiling heights that could be reconfigured into offices, co-working space, or other complementary uses? Next, evaluate your co-tenancy clauses. Do they specify a particular anchor by name, or are they tied to general occupancy levels? If an anchor leaves, what rights do smaller tenants have to reduce rent, terminate early, or demand concessions? In many cases, these clauses can be renegotiated before a problem arises. Replacement anchors such as grocery stores, medical clinics, or other essential uses can often be structured to satisfy co-tenancy requirements if the lease language allows for flexibility. Beyond traditional retail, landlords should also consider more creative anchor replacements. Indoor family entertainment centers, pick-and-pack fulfillment hubs, community colleges, or hybrid retail service concepts can generate consistent traffic and support stable rents. It is important to remember that repositioning a large format space requires both capital and time. Waiting until an anchor has already vacated often results in months of lost income, increased downtime, and pressure to offer rent concessions to retain smaller tenants. Proactive planning is not optional here. It is the difference between controlling the transition and reacting to it.
Force 2, vacancy as opportunity. At first glance, vacancy feels like a problem, but in a market defined by scarce supply, a vacant space is actually a rare asset. The advantage does not go to the landlord with the most space. It goes to the landlord who moves the fastest. When you receive notice that a tenant plans to vacate, your work should begin immediately. Do not wait for the space to go dark. Contact architects and contractors right away. Get preliminary estimates for subdivision, reconfiguration, or change of use. At the same time, update your marketing materials. Share those materials with brokers who specialize in your submarket. Ask them directly. Which brands are actively expanding? What size ranges are they targeting? What site criteria are deal makers actually responding to right now? Many expanding concepts need as little as 1,500 square feet. Others prefer 5,000 to 7,000 square feet. often with patio space or strong visibility. That variation is your opportunity. Design your spaces to be flexible enough to capture multiple tenant profiles. One effective strategy is delivering a white box. A white box includes working HVAC, restrooms, lighting, and full ADA compliance. This lowers upfront friction for tenants, shortens decision timelines, and expands your prospect pool. Another underused tactic is negotiating an early termination. Now let's move to Force 3. Flexibility is the new long term. For decades, retail leasing followed a familiar formula: long initial terms, rigid structures, fixed escalations locked in years in advance. That model is fading. Outside of single-tenant net lease deals, 20-year leases are increasingly rare. In multi-tenant centers, both landlords and tenants are prioritizing optionality. Tenants want room to adapt as their businesses evolve. Landlords want the ability to reset rents as market conditions change. A common structure today is a 5-year initial term with multiple renewal options. For example, a 5-year lease with 2 additional 5-year extensions. Base rent steps up annually, often around 3%. In stronger locations, that base rent may be paired with a percentage rent clause that activates once sales exceed a defined threshold. This structure aligns incentives. If the tenant succeeds, both parties participate. Flexibility also shows up in space rights. Expansion options allow a tenant to grow into adjacent space if sales justify it. Contraction options, used carefully, can prevent defaults by right-sizing occupancy before financial stress escalates. From the landlord's perspective, one of the most powerful tools is a relocation clause. Relocation provisions allow you to move a tenant within the center to unlock redevelopment or re-tenanting opportunities. These clauses typically require providing a comparable space and covering reasonable moving costs. But the payoff can be significant. They give you flexibility to subdivide large boxes, reconfigure traffic flow, or introduce higher rent uses without waiting for leases to expire. The goal is not to shift all risk to one side. The goal is to design leases that share risk and reward between landlord and tenant. In an environment where formats are shrinking and demand is changing quickly, flexibility is no longer a concession. It is a competitive advantage. Now let's turn to Force 4. Experience and data drive value. Consumers no longer view retail as a standalone errand. Shopping today is part of a broader experience. People want to dine, exercise, access healthcare, entertain their children, and socialize in a single trip. That shift has fundamentally changed what successful retail looks like. This is why open-air centers with diverse tenant mixes continue to outperform. They function as daily use destinations, not occasional stops. For landlords, the implication is clear. Tenant mix must support frequency, not just foot traffic. Incorporating food halls, brew pubs, specialty grocers, climbing gyms, yoga studios, urgent care clinics, dentists, and even beauty schools can transform a center into part of a customer's routine. But experience alone is not enough. Data has become the second driver of value. Technology now allows landlords to understand how people actually use their properties. Installing foot traffic counters, Wi-Fi analytics, and mobile engagement tools provides insight into dwell times, repeat visitation, and peak activity windows. This information is valuable on its own, but it becomes far more powerful when shared with tenants. Providing anonymized traffic data helps tenants schedule staff, optimize merchandising, and time promotions to match real behavior. That partnership supports tenant performance, reduces turnover, and ultimately supports higher rents. Experience and data also intersect with sustainability and wellness. Adding EV charging, solar panels, shade structures, and outdoor green spaces resonates with environmentally conscious consumers. These features can also unlock incentives, improve financing terms, and enhance long-term asset value. In today's retail environment, centers that feel relevant, measurable, and adaptive will outperform those that rely solely on legacy formats. Beyond the 4 forces, there are additional factors that can materially extend your competitive edge. The first is financing and capital markets. Cap rates remain relatively stable today, but they are not fixed. If interest rates rebound, cap rates could move higher. That makes monitoring credit spreads and lender sentiment essential. Many retail owners took advantage of sub 4% debt in 2021. Those loans begin maturing in 2026 and 2027. Refinancing risk is now real. Owners should evaluate whether refinancing earlier, while rates remain manageable, reduces long-term exposure. Not all lenders view retail the same way. Local banks and credit unions often understand small tenant centers better than large national institutions. They may offer more flexible terms when tenant rosters and operating history are strong. Choosing between fixed and floating rates should align with your risk tolerance, not just the lowest headline rate. The next consideration is the tax and regulatory environment. Property taxes are a major expense for retail assets. In many jurisdictions, assessments increased sharply following record transaction prices. If your assessment no longer reflects market reality, it should be challenged. Engaging professionals who specialize in property tax appeals can generate meaningful savings with limited downside. Regulatory changes also deserve attention. Some states are expanding online sales tax rules, which can subtly shift consumer behavior. At the local level, zoning changes can create opportunity or impose constraint. Municipalities that now permit medical uses in retail zones have opened the door to urgent care clinics, physical therapy centers, and other service-oriented tenants. Staying informed allows landlords to capture these opportunities before competitors do. Another critical area is insurance and risk management. Severe weather events, higher replacement costs, and tighter underwriting have pushed insurance premiums higher. Retail owners should review coverage regularly, not just at renewal. That includes property insurance, general liability, and business interruption coverage. Special endorsements, such as rental income protection, can be overlooked but materially important. One lever available to control premiums is adjusting deductibles. Higher deductibles can reduce annual costs, but only if reserves are sufficient to absorb a loss. Risk transfer does not stop with your own policy. Tenants should carry adequate liability and property insurance, and those requirements should be clearly enforced through lease provisions. Certificates of insurance should be tracked, verified, and updated annually. Failure to do so creates hidden exposure. Beyond insurance, operational discipline directly impacts NOI. Preventive maintenance is one of the highest return activities a landlord can undertake. Routine inspections of roofs, HVAC systems, parking lots, and landscaping reduce emergency repairs and extend asset life. Energy efficiency is another lever. LED lighting, low-flow plumbing fixtures, and smart irrigation systems can materially reduce operating expenses with relatively modest capital investment. Effective operations also depend on visibility. Property management software that tracks work orders, rent collections, and tenant communications improves responsiveness and accountability. Just as important are regular tenant check-ins. Asking tenants about sales trends, staffing challenges, and expansion plans often reveals issues before they become defaults. Early awareness allows landlords to intervene constructively, protect income, and preserve occupancy. Now let's turn to marketing and community engagement. Strong retail centers do not market accidentally. They build a recognizable identity that starts with a clear digital presence. A dedicated website and active social media channels allow you to highlight tenants, promote events, and communicate momentum. Marketing should not focus only on leasing. It should focus on activation. Seasonal events such as farmers markets, holiday festivals, charity runs, and outdoor movie nights bring repeat visitors and strengthen tenant sales. Offering free Wi-Fi encourages patrons to stay longer, check in, and share experiences online. That organic visibility extends reach beyond your immediate trade area. Community partnerships also matter. Working with local schools, churches, and civic organizations anchors your center into the daily fabric of the neighborhood. These relationships create loyalty that national brands alone cannot replicate. Marketing efforts connect directly to broader ESG considerations. Environmental, social, and governance factors are increasingly important to tenants, lenders, and investors. On the environmental side, initiatives like recycling programs, water-efficient landscaping, and LED lighting signal long-term stewardship. Social initiatives, such as supporting local charities or hosting community meetings, enhance reputation and tenant goodwill. Governance matters as well. Clear leasing policies, consistent tenant treatment, and transparent communication build trust and reduce friction. In some cases, strong ESG alignment can unlock better financing terms or attract capital-seeking responsible investments. Let's expand further on tenant mix and emerging retail segments. While food, fitness, and medical uses remain strong, they are not the whole story. Several other categories are quietly gaining momentum. discount and off-price retailers continue to grow as consumers trade down and prioritize value. These tenants tend to be resilient across economic cycles and drive consistent traffic. Pet services are another fast-growing segment. Grooming salons, veterinary clinics, pet supply stores, and even pet-friendly cafes benefit from rising pet ownership and strong emotional spending. Automotive-related uses remain durable as well. EV charging stations, car washes, and service centers support frequent visits and long dwell times. Experiential retail continues to evolve. Concepts like escape rooms, virtual reality arcades, and axe-throwing venues attract younger demographics and generate social media visibility. Education-oriented tenants also deserve attention. Tutoring centers, STEM programs, language schools, and test prep facilities create weekday traffic and stable demand. A newer category to watch closely is micro-fulfillment. Small logistics hubs and dark stores allow retailers to shorten delivery windows and integrate online sales with physical locations. No single category is a silver bullet. The objective is diversification. A balanced tenant mix reduces dependence on any one sector, smooths income volatility, and broadens the center's appeal. Now let's look at case studies that put these strategies into real-world context. Consider a 1970s-era strip center in a northern Atlanta suburb. In 2023, the property lost its 30,000 square feet department store anchor. Rather than searching for another large-format tenant, the owner chose a different path. The space was subdivided into 6 suites: a 15,000 square feet specialty grocer, a 5,000 square feet climbing gym, a 4,000 square feet specialty pet store, and 3 2,000 square feet units leased to a nail salon, an urgent care clinic, and a tutoring center. That repositioning required approximately $5 million of capital investment, but the result was a 40% increase in overall rent and a meaningful reduction in co-tenancy risk. A second example comes from West Midtown. A neighborhood center replaced a failed party supply store with a local brewery paired with a weekly farmers market operating in the parking lot. Foot traffic doubled on weekends, lifting sales across surrounding tenants. Not every story ends this way. Failure to adapt can be costly. In a southeastern suburb, a landlord allowed a grocery anchor to go dark in 2022 without a contingency plan. Co-tenancy clauses gave smaller tenants the right to reduce rent by 50%. Net operating income fell sharply, and the center lost momentum. It took more than a year to secure a replacement anchor. During that time, additional tenants left for competing centers. Had the space been subdivided earlier, or a replacement anchor been lined up proactively, much of that revenue loss could have been avoided. Now let's broaden the lens beyond Atlanta and look at what's happening in other fast-growing markets. These examples differ by region, but the underlying lessons are the same. In Texas, one of the most notable trends is the expansion of HEB. Its discount concept, Joe V's Smart Shop, has been aggressively filling former big box spaces. These stores target cost-conscious consumers and thrive in value-driven environments. For landlords, this highlights the importance of aligning space size and pricing with shifting consumer behavior. In the Carolinas, a different dynamic is playing out. Publix and Lidl are competing for market share near new housing developments. That competition is driving demand for 20,000 to 45,000 square foot grocery anchored spaces. Retail continues to follow rooftops, and landlords positioned near population growth are capturing outsized demand. In Florida, outdoor lifestyle centers are outperforming enclosed malls. Projects that integrate entertainment uses such as Topgolf, iFlea, indoor skydiving, and Dave & Buster's are seeing stronger traffic and longer dwell times. These centers function as destinations, not just shopping locations. They blend retail, dining, and entertainment into a single experience. Across all of these regions, the pattern is consistent. Formats are adapting, tenant mixes are diversifying, and experiences are driving value. Markets differ, but the principles do not. Landlords who stay flexible, anticipate tenant needs, and evolve their properties are outperforming those who rely on legacy models. Now let's bring this back to Atlanta and translate everything we've covered into a clear, actionable playbook. This is where strategy turns into execution. Step 1. Re-audit leases. Start by gathering every active lease document. Summarize co-tenancy clauses, exclusive use rights, termination options, renewal options, and rent escalation schedules. Pay close attention to clauses triggered by anchor closures or occupancy thresholds. If language is ambiguous, address it now, not during a crisis. Engage legal counsel to draft fallback provisions that allow replacement anchors of similar size or essential category to satisfy co-tenancy requirements. Step 2. Build a space inventory. Create a matrix of every suite in the center. Include size, current tenant, lease expiration dates, renewal options, co-tenancy dependencies, and subdivision potential. For spaces larger than 10,000 square feet, develop multiple test-fit layouts showing how the space could be subdivided. For spaces between 2,000 and 5,000 square feet, identify complementary uses: fitness, medical, food and beverage, pet care, and education. Step 3. Engage brokers and tenants. Host quarterly broker meetings to preview upcoming availabilities. Ask brokers which concepts are expanding, what lease terms they are seeing, and which site criteria are driving decisions. Maintain a live prospect list with tenant requirements and timing. At the same time, check in with existing tenants. Ask about sales trends, operational challenges, and expansion or contraction plans. Early insight creates leverage. Step 4. Offer creative lease structures. Use shorter initial terms with multiple renewal options. Incorporate step-up rents that increase annually. Use percentage rent clauses where appropriate to participate in upside. Include relocation provisions that allow flexibility for redevelopment or retenanting. For creditworthy single-tenant deals, longer terms can make sense, but only if escalations keep pace with inflation. Include language that allows installation of EV charging or solar without tenant objection. Step 5. Invest in experience. Evaluate opportunities to add communal spaces, green plazas, playgrounds, public art, or small event areas. Consider rotating pop-up spaces for local artisans, seasonal markets, or short-term activations. Partner with local chefs, fitness instructors, or community groups to create programming that drives repeat visits. These initiatives often cost less than major capital projects, but generate meaningful buzz. Step 6. Deploy technology. Install foot traffic sensors at key entrances and within large tenant spaces. Use Wi-Fi analytics to measure dwell time and repeat visitation. Share anonymized data with tenants in quarterly reports. Use digital signage to promote events, highlight tenant promotions, and guide parking flow. Support all of this with a property management system that tracks maintenance, rent payments, and tenant communication. As we come toward the conclusion, here's the simple takeaway. Retail heading into 2026 is defined by scarcity and fragility. Supply is scarce. New retail product is barely coming online. That scarcity is keeping vacancies tight and supporting rents. At the same time, anchors are fragile. Department stores and legacy formats are shrinking, restructuring, or disappearing altogether. That combination creates both risk and opportunity. In Atlanta, this dynamic is even more pronounced. Vacancy remains unusually low, and rent growth has held up because there is almost no new inventory entering the market. That puts the advantage in the hands of landlords who act early. Clean up co-tenancy language. Address default provisions before they are tested. Pre-plan backfills. Subdivide large boxes before they go dark. Flexibility is power. Speed is leverage. The landlords who wait for certainty will pay for it in lost income and lost control. So here's the challenge. Pick one thing from this series and execute it in the next 7 days. If your anchor is soft, retrade the risk before the risk retrades you. If you have upcoming expirations, start the tenant hunt now, not when the space is dark. If this series helped, like, subscribe, and turn on notifications. Drop a comment with your biggest landlord challenge in Atlanta right now, and I'll prioritize it in the next update. I'm Amit Grover with ECMP Studios. If you want a landlord side strategy review for your center, reach out directly. Let's keep learning, keep planning, and as always, keep it real. Estate